My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll do it, my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. At last, the economy slowed enough that the Fed can take its foot off the brakes and step on the gas. That's why we're starting our game plan in the middle of next week, when the Federal Reserve renders its verdicts, 25 or 50 basis points. We don't typically have a lot of drama in this business, but this one counts as a nail-biter, because we really don't know how big the rate cut will be. We just know they're going to cut. Today's rally, with the Dow gaining 297 points, S&P advancing 0.54%, Nasdaq climbing 0.65%, capping off the best week of the year for both the latter two, the S&P and the Nasdaq, suggests the Fed might actually go 50. That's a double rate cut. I know this because the stocks most sensitive to interest rates, the housing and housing-related names, went off today, to use a little NFL fantasy football lingo. They soared, presumably in anticipation of something huge from J. Powell and company.
All aboard!
I still find myself betting on a quarter-point cut, though. See, it's not that we don't need a half-point cut, as the economy is slowing pretty quickly, especially for the lower-income cohort. But I've always believed that the Fed should be measured when it cuts rates. At this stage of the business cycle, the biggest risk is that inflation might flare up again if you cut too much. And a 50 basis point cut all at once makes that a lot more likely. Plus, a double rate cut signals that something may be very wrong with the economy, something we don't know about, something lurking. So going 50 could inspire panic. And there's simply no reason for the Fed to take that chance when it can simply hit us with a series of thoughtful 25 basis point cuts that neither reignite inflation nor cause panic. Now, if the housing rally continues at this pace, these stocks run the risk of being too hot to handle for a mere 25 basis point cut. And we'll get a sell-off in response in those stocks. Keep in mind, housing caught fire because a reading from CME Group's FedWatch tool, which tracks interest rate expectations based on the Fed funds futures market, indicates that traders are now pricing in a much higher probability of a double rate cut, currently 45%. That's much higher than it was a week ago. These people will indeed be disappointed if the Fed decides to be more measured. These gunner traders could be your enemy come Wednesday at 2 p.m. as they dump what they bought incorrectly. And that is what happens. That's what traders do. They let the stocks go. Now, there are other important events next week. We'll be broadcasting, by the way, from San Francisco all week, making our annual pilgrimage for Salesforce's Dreamforce conference. It's going to be a couple of big days. By the way, I'll be at Dreamforce on Tuesday. But let's not get ahead of ourselves with the game plan. On Monday, Regeneron's presenting, that's a biotech company, and holding an analyst meeting at the European Society for Medical Oncology's annual meeting, where they'll showcase their oncology portfolio, which is bountiful, including formulas to treat advanced melanoma and non-small cell lung cancer. These are important drugs that have helped diversify Regeneron's business, but I'm still focused on the company's obesity drug candidate. When I was at a J.P. Morgan Healthcare Conference in San Francisco earlier this year, I pulled up with Regeneron CEO Len Schleifer. He's an old friend of the show who was one of our first guests. He was confident that his company might have a weight loss drug that only attacks fat, not muscle. That's huge, as people who take GLP-1s experience muscle atrophy unless they work out pretty consistently. I think this drug would be an instant success if it can get through the clinical trials. Right now, it's too early in the process to take anything as gospel. Tuesday, we get retail sales, perhaps the last data point before the Fed renders its decision. Now, normally I wouldn't sweat the program here, but the number represents the best gauge of consumer spending, and two-thirds of our economy runs on consumer spending. I think, actually, it's going to be a weak number. When you're at the beginning of a rate cycle, you've got a rate cut cycle, you have to indulge in a leap of faith. You have to just take it as gospel that 25 or 50 is going to ignite housing-related construction no matter what. And that's how it normally plays out. So you might be interested in a company, we had them on actually, called Ferguson, which distributes all sorts of products that go into new construction. Think plumbing, appliances, heating, ventilation, air conditioning systems, HVAC. Ferguson's levered directly to interest rates, which is what you want when the Fed's about to start easing. Now, we don't just get the Fed's decision on Wednesday. We also get earnings from General Mills, which is on a mission to upgrade its portfolio. Mills just offloaded its North American yogurt division for $2.1 billion. It represents, now, what's it got, really? When you look at the pastiche, it's got snacks and pet food franchises. They're very, very strong. And I think you're getting a bargain with the stock here. Unfortunately, Wall Street tends to abandon the packaged food place when the Fed starts cutting. They grow too slowly for traders. Thursday, well, there's a cornucopia of earnings, starting with Darden Restaurants, which tend to swing with the same-store sales of its largest division, which is Olive Garden. It could surprise, but you know what? After speaking to the CEOs of Sweet Green and Cava in the last couple of weeks, I vastly prefer those two fast casual chains. Even up here, they're worth buying on any pullback. Cracker Barrel also reports, and talk about a work in progress, the redoubtable and implacable CEO, Julie Masino, is attempting to turn this old battleship around, and it won't be easy. You have to keep the current clientele pleased while luring in new people. Messino's approaching this term methodically. I really like that. I think she can get it right. I just don't know if she can get it right this fast. Again, I'm calling this a work in progress. After the close, we get results from FedEx and Lennar, two incredibly important companies for the economy. FedEx is undergoing a gigantic turnaround led by CEO Raj Subramanian, who's cutting costs while growing revenues. Oh, that's a near impossible task. But he's pulling it off. And Lennar, classic home builder. Hearing from them a day after the Fed meeting could be very enlightening. I think Lennar will tell a terrific story. And if we get a 50 basis point cut, its stock might be a terrific place to be. When I look at next week, I can only conclude that we're finally at the moment we've all been waiting for. So let me give you the bottom line. If we sell off on a 25 basis point rate cut, remember this phenomenal week, because there'll be plenty more like it as the easing process continues and progresses. Oh, there will be bear phases too, but as long as you recall that we're no longer fighting the Fed, those phases can be bought, not sold. Bye.
All aboard!
Matt in Massachusetts. Matt.
Hey, Jim. Booyah.
Booyah, Matt. What's happening?
Well, I want you to know that me and my 8-year-old daughter watch your show every night, and I've been watching it since you came on over 20 years ago. So
does she like NVIDIA here? What is she doing? Is she swapping out of NVIDIA and going for more Amazon?
She still has some NVIDIA, and she loves AT&T, actually.
Really? She's a contrary player. Well, you know what? The kid's got horse sense because the stock's going up. Now, it's going up without me, but you can tell your 8-year-old daughter that she is spot on. I saw the interview that David Faber did with the CEO of AT&T. She's right. I congratulate her for a really good call. Now, what's your stock right now?
So I'm long on Schlumberger in my retirement, but I'm getting killed lately, and I'm wondering if it's to hold on to it or...
Matt, this is such a tough one. SLB is an amazing company. I actually interviewed with SLB in 1983 for a job, and they told me to get the hell out. I didn't know anything. And I took that as gospel. I do think that SLB is a very inexpensive stock, and I would not sell it down here. Let's go to Stephen in New York. Stephen.
Jimmy Joe. Hope you're doing well on this Friday evening.
Getting ready for a big wedding this weekend. Can't wait.
Awesome. My question is about TPL. The stock's up about 50% year to date, approaching its 2022 high. TPL is primarily an oil and gas royalty company, but the water business is growing. It's now about a quarter of the company's net income. Do you think they should keep that sleeve of their business or maybe spin it out into its own water utility?
Why do I love this show after all the years? Because here's Stephen telling me about a stock, TPL, that I don't know enough about, and this water business. And I'm going to sit down with our chief scientist and research director, Ben Stoto, and get to the bottom of whether TPL is worth buying. I had no idea about the water business. Thank you very much, Stephen, for teaching me. I get taught every day, and I like being taught. After a rate cut, as long as you remember that we're no longer fighting the Fed, bear phases can be buying opportunities, not selling ones. Well, man, tonight, has former Ulta CEO Mary Dillon put her best foot forward during her tenure so far at Foot Locker? I sat down and tried a pair of shoes on with the top brass herself at the company's new Herald Square store to find out that Adobe stock hasn't been doing so hot. But is the company illustrating that it could stage a turnaround? I'm going to give you my take. And we held our monthly investing club meeting yesterday and had so many questions from club members and not enough time to take them. So what we're going to do? I'm digging into the rest of them tonight. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
When Foot Locker reported about 2 weeks ago, it delivered what I thought was a great quarter. Yet the stock tumbled 10% in response, and it kept sinking until it finally found its footing a few days ago. At the time, I told you the sellers simply don't believe management's full-year earnings forecast. But if you think Foot Locker can make the numbers, then you are getting one incredible buying opportunity. So can they pull off this comeback? Earlier today, we spoke with Foot Locker turnaround artist CEO Mary Dillon at the company's newly reopened and reimagined location in Herald Square that features all new tech and personalization that's special to this concept. Take a look. Mary, you're reimagining everything, and we are in the home court of a new store. What do you got for us?
Yes, we are. Well, thank you for being here today. First of all, we're celebrating the 50th anniversary of Foot Locker this week. And if you don't mind, I just want to show you what I'm wearing, which is a special 50th anniversary Air Force One made by our pals at Nike. And many of our brand partners have done special edition shoes, as the kids like to say, very demure, very mindful.
They want to be in Foot Locker.
That's right. So we are in our 34th Street store here in Midtown Manhattan, and it's one of our reimagined stores. And this is really the blueprint for where we're taking Foot Locker, okay? We're reimagining our stores, our brand partner experiences, our digital experiences, and our connection with our customers. So we also are in the home court, which is all things basketball, and this was designed, Foot Locker, in conjunction with our partners at Nike and Jordan brand. And this is about bringing all things on court and off court, the lifestyle of basketball, together in an immersive shopping experience.
I think it's important for people to know that you have solidified the relationship with Nike to the point where you're getting the absolute best. Some felt that Foot Locker wasn't getting that. This, to me, is really the most important stuff that Nike has to offer.
Well, listen, I'm excited about where we're heading with all of our brand partners, and Nike and Jordan brand, very important to us. You can see many of the launches here. In fact, we have some new Kobe's up there on the shelf. And, for us, it's about really building together with all of our brand partners to drive category growth, we're gaining market share, and I'm really proud about that. And we're also expanding sneaker culture because people come to sneakers for a lot of different reasons. And this store is a good example of making it easy for more people to find sneakers.
What people may not realize that you've explained and I now understand is this is actually a category, even for lower income, that is prioritized. Why is that?
Yeah, that's how I like to think about it, that this is a category for everybody. Seriously, I really believe that we can expand sneaker culture. The more people see the ways that you can bring sneakers into your lives. But for our customer, this is, we tend to skew towards a younger, multicultural customer. By definition, they're just starting their careers, less income to spend, but this is a category that they prioritize. Just like other people might prioritize beauty, our folks' categories, they prioritize this category. And so when we have the right products at the right time, people are coming out and spending. So back to school, we came in strong, holidays right down the horizon. And we came out of the second quarter with global comps positive, plus our AUR up. So average unit retail. So people are paying full price.
Well, let's talk about global comps. You are actually now finally in expansion mode. In India, you are getting out of stores that were not necessarily working. And the lace-up plan that you explained to me when you first started is really coming to fruition.
Yeah, I'm really proud about the strategies that are working, and it's really about simplifying to invest and then grow. And the strategies are around, bringing more people into sneaker culture. We call it powering up our portfolio. So really optimizing our footprint, everything from where we operate to the look and feel of the experience for our customers, becoming a much stronger omnichannel player, and really deepening our relationship with customers through things like our global Heart of Sneakers platform for Foot Locker, our first ever global campaign, and our loyalty program.
Now, let's talk about the loyalty program because this is new, this is different, and I know the lift, 24%, is fantastic for loyalty, and this is just beginning. So tell us about what this can mean for your numbers.
Yeah, so first of all, we already had a loyalty program called FLX. It was focused a lot on access to launch, so some of the exciting launch product. But that's only a part of what we do. And so what we've done now is relaunch FLX to continue to have access to launch and making that even more fun, but really creating more of a traditional program. If you spend with us, you get points for a future cash discount. And so last quarter, our loyalty penetration was 24%. We know that can get to 50% in a couple years. It can get way higher than that. And the power of a loyalty program, it works on many levels. One is obviously you want our customers to spend more of their share of wallet, their hard-earned dollars with us. But also it gives us more ability to communicate with our customers over time in a much more personalized way. And that's part of our plan in terms of how we get to the profitability that we're aiming towards in 2028 is less reliance on, promotions and more this kind of marketing.
Well, let's talk about the greatness of your previous loyalty program that you invented at Ulta. I always find that Ulta was the benchmark of greatness for loyalty. Can you do that here?
Yeah, I mean, listen, our loyalty program today at Foot Locker is taking from all the best of the best. We know what customers are looking for. It's a couple things. Keep it simple. Don't overcomplicate it. Make it easy to sign up and easy to access your loyalty points. And then also add some bells and whistles that are relevant to your customers. So again, for us, it's things like maybe getting special access to an NBA game. Maybe it's learn about how to apply your points to the hottest heat product. So those are the kind of things that we're going to do with our loyalty program. And then we're launching our new mobile app later this year. And that's going to make it that much better because our customers will have easier access to everything in their loyalty program. And our Stripers will have easier access to technology that helps the store experience get even better.
Now, what are you doing in terms of getting the best help? I've felt previously to you coming in here, sometimes I would have to wait a little bit when I would go in. And obviously it's a competitive world. I don't want to wait at Foot Locker, but are you staffed right now?
Yeah, listen, our Stripers, as we call them, are the best in the industry. It's really what excited me about coming to run Foot Locker. I love retail because we create jobs and opportunities and careers for people. But this company is especially special, I would say. And so, yeah, sometimes we're busy, but what we're trying to do is make sure that our Stripers have the tools and technology and training. They love nothing more than to really delight our customers, to teach them about what's new and hot. In this store, we can customize your sneakers for you at our sneaker hub. We have an area that we call the Kick It Club, which is really about making the try-on experience fun and communal. And so when our customers get a chance to really interact with our Stripers, who are experts in this category, that gets them excited, and frankly, I think it helps us sell more.
Are they excited about the fact that you have New Balance, Hoka, Asics, you've got Brooks, and you've got Crocs? This is a very diverse group of shoes that people have to be able to show.
Yeah, so we talk about expanding sneaker culture, which means people want choices, and they use sneakers for a lot of different occasions, not just one type occasion, and even seasonal products like UGG, you mentioned Croc, Timberland, right? So I think our Stripers love to be able to represent the best of all things in the category, and we try to help them get as expert in every single brand that we sell so that they can help our customers find what's right. One of the things in this store and our new stores is that we have technology that helps you figure out what the right shoe size is. I know that doesn't sound like rocket science, but it can be, and we make that a fun digital experience as well.
Oh, that's so you have good data on people to make it so that you're not coming in the first time over and over again.
We're just trying to help folks.
Now let's talk numbers. Second quarter 2024 highlights: comp sales up 2.6%. That's a terrific number. Gross margins. I've been waiting. You're getting the expansion. Inventory's down. These are all the let's say the bones of a turn. Are you happy where you are now? Because I know that you did have to say, look, it's pushed out a little bit. Are you on time now?
Yeah, I feel really good. I mean, coming out of the second quarter, global positive comps up 2.6%. This is a big, complex global business, and that was a really good marker for us, as well as being able to expand gross margin. And our inventory is down. And what's happening is that I'd say things are just really starting to come together all at once. Our brand partnerships are strong, so we have access to the best of the best. Our inventories are cleaner, so we can make sure the best of the best is in front of our customers. But things like our investment in the NBA, our brand health, our platform called the Heart of Sneakers, as I mentioned, loyalty launching, stores being refreshed. We're going to have 2/3 of our Foot Locker stores refreshed globally by the end of 25. So all those things come together to support the momentum, but we have a lot more still to come. So loyalty is just scaling. The store refreshes are just scaling. The mobile app is still coming. So And, when we see customers come out and prioritize the category and spend at back to school, spend at holiday, we think it's, we're on the move, and I'm proud of the progress we're making.
Okay, so footwear up high single digits, accessories up mid-single digits, apparel down mid-teens. What are you doing to change that?
Yeah, that's a little bit of a tougher category. It's a smaller category for us, so we're really think about ourselves leading through the lens of sneakers. But, right now we think we're in a good position from an apparel inventory perspective. We're getting more focused on a couple things. One is key items and depth around key items, connecting them to sneakers. That's what our customers love to do. And also really putting even more prioritization on our private label brands, both at Foot Locker and at Champs.
The Mary Dillon we're talking to is 40 years in retail. You did not have to come back. You've been incredibly successful.
40 years, thanks,
How about just a quick, let's say, autobiography retrospective of where you are in the arc of retail and where our country is in terms of shopping?
Yes. Well, okay. First of all, brick and mortar is never going to be dead. And you have to invest in your stores to make them exciting for your customers. But for certain categories like sneakers, we're always going to have to be great in store and online because that's how people want to shop. And just, for me personally, yeah, I've been in the business world for 40 years and retail for the latter part. But I started working, when I was 15 years old. Like a lot of CEOs I know are very self-made. And part of my journey, putting myself through college and whatnot, was working in retail stores or waitressing or whatever. To me, I have a lot of heart for the responsibility that we have to create jobs and careers. And frankly, when I travel to stores and my team, we spend our time talking to our store managers, our stripers, and asking them what's working and what's not, because guess what? They know best. And so that is really energizing for me.
Instead of telling them what they should know, they tell you what's really happening.
Quite often.
Well, I got to tell you, Mary, as usual, you are a remarkable person for doing what you're doing, and you mean all those things. There's a lot of mouthing of what people do. You've promoted people. You've created careers. You've taken advantage of what you have to help others, and it's really incredibly important, and it's a gift.
Thank you.
Absolutely.
Appreciate that.
Mary Dillon, Foot Locker President and CEO. Thank you.
Thank you.
Coming up, they're the perfect marriage of nimble tech and artful imagination. But marriage is hard. Cramer checks in on Adobe. Next.
All right, what the heck happened to the stock of Adobe today? Last night, the cloud software colossus dominates digital media, marketing, and e-commerce with a rapidly growing AI kicker. Reported a terrific set of results. But their guidance for the current quarter was a tad light. So the stock got eviscerated today, down 8.5%. I was really looking forward to these numbers from Adobe because a host of sell-side analysts started flogging the stock earlier this week. There were at least 4 price target hikes right ahead of the quarter, with Wells Fargo actually adding the darn thing to its signature picks list. When so many analysts get this bullish on the stock right before the quarter, they either know something you don't, something good, or it's a groupthink situation where the bulls got way ahead of themselves. In the end, Adobe reported an excellent quarter, but paired it with cautious guidance for the current quarter. And that caused shareholders to flee like rats from a sinking ship. The stock got crushed, falling from 586 to 536 and change. And remember, this is like one of the best week of the year and a great tech tape today. You know what? When you really dig into the quarter, I think you're getting a great buying opportunity here. Yep, I pounced on Adobe into this weakness. I'm going to tell you why. First off, the quarter itself was very strong across every major business line. Adobe gave us healthy top and bottom line beat with no real areas of weakness at all. When you look at some of the key cloud software metrics that Wall Street watches, they were strong. Adobe's net new digital media annualized recurring revenue, that's a mouthful, but it came in way ahead of expectations. That was the number I cared about. Second, even though the guidance for the current quarter was indeed soft, well, it wasn't that soft. Management's talking about $5.5 to $5.55 billion in total revenue, when the analysts were looking for $5.6 billion. They say they can earn $4.63 to $4.68 per share for the quarter. The analysts wanted to see $4.67, so I would call that, let's say, in line. Of course, this was Adobe's fiscal third quarter, which means that when they reported in June, investors had everything they needed to extrapolate what the numbers could look like in the current quarter. Their fourth quarter, we had the first half results, we had the third quarter guidance, and we had the full year forecast. I think this is driving much of the selling because the new fourth fiscal quarter guidance does seem weak versus what Adobe was implying it could do just in June, the last time it reported. Basically, 3 months ago, management was signaling that business would accelerate a bit into the end of the year. Now the third quarter guidance basically says that things will just stay steady or even decelerate very slightly at the end of the year, hence the plummeting stock. Now, I know that all sounds suboptimal, right? But management explained what's happening here. For example, they expect to take more of a hit from currency fluctuations, which is beyond the company's control. At the same time, a few major deals closed early. This would have been the fourth quarter business, but it came in ahead of schedule. High-quality problem. On the cost side, Adobe says that it's ramping its go-to-market spend, which is really just what people in the software industry say when they mean sales and marketing costs. They apparently need to spend more thanks to the increased pace of innovation. Sounds right to me. For example, Adobe's always had a lower-cost Express version for its, of software for individuals. But they've launched new versions of Express for students, teams, and enterprise customers, and now they got to go out and market those products. So how much should you care about Adobe's light fourth quarter guidance? Honestly, it's tough to say. If we're only talking about the fourth quarter guidance, I'd be inclined to shake off the conservative outlook, especially given that the company just reported a very strong set of quarterly results, and management made it clear that the outlook for the current quarter is being dragged down by one-off issues that I just mentioned. But at this point, who cares about the current quarter, right? The more important question is, what does 2025 look like? And it would have been much easier to be more optimistic about 2025 if Adobe's business was accelerating to the end of the year, as we previously thought. And remember, it does sound like now that it's decelerating. Now, if you want to be bullish on Adobe, the great fear is that some of these competitive AI technologies are starting to weigh on their ability to sell their product suites, even the ones that now include Adobe's own AI functionality. Unfortunately, after this quarter, we won't be able to dispel that concern anytime soon, probably not until December, when the company reports again, and likely gives us our first glance at its forecast for the 2025 fiscal year. So until then, you may have to put up with some volatility in the stock if you do some buying. But overall, I'm inclined to stick with Adobe, which has done so well for us so long. I think the company is compelling, competitive AI offerings. Competitive meaning that there is competition. That is a problem. And they've got the best, I think, the complete suite of AI tools. I've looked at them. I've worked with them. They're amazing. Adobe CEO Shantanu Narayan stopped by CNBC's closing bell yesterday and got at this point. He said, we're all looking forward to the Fed cutting interest rates and for the election to be in the rearview mirror. But for Adobe, what matters is they've got the right products, and those products are starting to gain real traction with customers. He went through a bunch of popular new initiatives, giving enterprises a customer data platform that can engage directly with their users, the Firefly AI service that lets you automate content production. That thing is lightning. It's so great. Adobe Express and the budget version of their graphic design platform that's aimed at consumers, not professionals. Frankly, though, I think Adobe's a buy on weakness here because we've seen this movie before. The stock has periodic post-earnings sell-offs, and more often than not, those have been excellent buying opportunities. We saw it when the stock sold off around this time last year because they postponed rolling out their full-year forecast by 2 months. We saw it early this year when the stock sold off on nebulous fears of AI competition, including some more concrete fears about OpenAI. And the bottom line here, I am betting it happens again. Yep. That's why I think Adobe's worth buying on the way down. But keep in mind that the next few months could be extremely volatile, so there's no need to jump in with both feet. Still, as I see it, Shantanu Narayan and his team at Adobe, after multiple years of success, have earned the benefit of the doubt. Let's take calls. Let's go to Chris in Florida. Chris.
Jimmy Chill, Chris Diggs from Jupiter, Florida.
Yeah, hey, man, I'm sorry about that loss last night. I mean, whatever. But unless you're from Tampa Bay, that's a different story. How can I help?
Okay, here we go. I'm a large holder of both Salesforce and ServiceNow. Currently, I'm overweight ServiceNow since the parabolic move to new highs. I have two choices. One, stay overweight ServiceNow, understanding that Bill McDermott is a superstar and will continue to grow revenue north of 20%, or buy more Salesforce, balance out my position, and move on.
I am inclined to tell you to hold both, don't buy. I do not want you to sell ServiceNow. I think they're having a terrific year and a terrific quarter. The stock is up very high, but I think it's going to be able to blow away the estimates. Salesforce, I got to go see. I got to tell you, I got to go out there and take the measure of the place. I was talking to a bunch of people today about how I don't feel certain enough to be able to say the right thing about Salesforce until I see the whites of their eyes. And that's next week's business when we go out for Dreamforce. Now, I think the team at Adobe has earned the benefit of our doubt, and that's why I think it might be worth buying on the way down. Once any volatility settles, I feel very alone on that. I don't care. Much more Mad Money ahead, including a closer look at what we do for our club's monthly meeting when I take your investing questions. Then I don't love recommending stocks right when they're soaring, but sometimes you have no choice. I'm explaining why I'm feeling great about one company whose shares are going through the roof right now. and all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Yesterday, we held our CNBC Investing Club monthly meeting. Once a month, Jeff Marks and I get together to walk club members through our thought process of how we make decisions for the portfolio. We discuss our current holdings, and then we take questions from our club members. My favorite part of these meetings is taking your questions. And since we didn't have enough time to go through all of them, I'm going to give you an inside look at what we do for the club tonight. First up, we're taking a question from Tad in California, who asked, any ideas why ELF is on the shelf? Earnings weren't bad enough to cause the stock's big drop. Guidance didn't blow anyone away, but it was in the ballpark. International expansion is going great. So what's going on? Okay, a couple things. One, ELF is a heavily shorted stock, and I thought the shorts came in and leaned on it, and that scared a lot of people. Secondly, though, you got to understand that Estee Lauder just seems to go down almost every single day, and Ulta has been very weak. So the cosmetic group is doing terribly. ELF is the best house in a bad neighborhood. That's not a place to be. Now let's go to Nicholas in Georgia, who asks, how do you think equities are going to react to a 50 basis point cut versus just 25 basis point next week? I'm now in the 50 camp and curious about your take. Okay, the 50 camp now, because of what happened today and this week, remember, best week of the year, S&P and NASDAQ, we're now set up for actual disappointment if we get only 25. So just be aware, we don't want to get too long or ahead of ourselves. May even want to take some stuff off ahead of the Fed meeting because we are now once again overbought on the oscillator that I like so much. Next up, we're going to David in Connecticut, who asks, what do you think of Shark Ninja as a lower interest rate investment play? The thinking being that as people update their homes, they will want new devices to go along with it. I got to tell you, I don't even think you need to have lower rates. This thing is electric. The more I look at it, I look at the stock every day. I said, why didn't we, after meeting them, just buy the stock for the Travel Trust? It has been such a good investment. And by the way, it has a lot of really interesting, like the ice cream maker, things that nobody else has. So the answer is, I don't care so much about rates. I care about ingenuity, and they have it in spades. Next up, Ronald asks, I own a stock that does not pay dividends. How does a stock buyback add value to my portfolio? You give you fewer shares, so therefore when you divide into fewer shares, you get a larger earnings per share number. So it is actually returning money directly to you. Now let's take a question from Greg in Maryland, who asks, Oracle has redeemed itself from a misstep earlier this year, but how do you think it will do going forward as the hyperscalers prepare for AI with massive capital investment? What are the key indicators we should be looking at? Well, I got to tell you, we should have been discussing this question last week. It's been a remarkable run the company's had. It is indeed the run that I wanted, and I talked yesterday at the club call about how I got impatient because the company kept missing numbers, and then it blows the numbers away. But now it's giving you a very big forecast for the out years, which means not right now, not next year, year after, and it looks like it's stellar. I think that a lot of the good news is in the stock. Probably has another 10 points, though, as other analysts get on the board because there's still too many people who are negative. Next, Kim in Florida says, I believe the healthcare sector can be one of the primary beneficiaries of AI over the next few years. Is there a company you believe could be one of the biggest winners? Well, just so happens that GE Healthcare had a big stock offering today from GE. It's knocked the stock down, and they are my favorite AI play when it comes to healthcare. So GEHC is the best way to be able to invest when it comes to AI and healthcare devices. So I want to thank all of our wonderful viewers. Make sure to join the club ahead of next month's meeting at cnbc.com/investing club. We'll go out to San Francisco. Don't worry, I'm not going to let you down. We will still do our videos. Mad Money is back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. That's where I take your calls rapid fire. I say the name of stock, tell you buy, sell, just because on the core stock questions at time. My step bridge, grab it to the blade. Play this on. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. Kramer's right. Start with Kevin in Illinois. Kevin.
Jim, I am a huge fan. My wife is an even bigger fan. Anytime your show is on, we're not allowed to talk in our house. She hangs on every word. My big question is,
I think that makes sense.
Motorola
Why should you
Solutions.
talk over me?
Big
Like I'm
tech
talking
company.
over you right now. I don't mind that one bit. What was the stock?
Motorola Solutions, MSI.
Oh, that's a Chicago-based company that is incredibly good. I've got to tell you, this is a company that does two-way radios, it does barcodes, it does lots of government infrastructure, and it just coins money. And I would welcome Greg Brown on the show anytime because he is a remarkable executive. And thank you for the call, and thank your wife, too. Let's go to Nathan in Pennsylvania. Nathan.
Hey, Jim, it's great to talk to you again. It's been a while. Hey, I just want to say that I enjoy listening to you, Carl, and David on the morning show. You guys are fun and informative, and it's a shame that you guys have not won an Emmy.
Well, hey, I'm glad you like that show. That show is just a blast, and I think we do a lot of good stuff. First 20 minutes, most watchable business show on Earth. How can I help you?
Yeah, that's the show in the morning. Hey, what do you think of the company and the stock of Federated Hermes Investors, FHI?
That's an investment management company that I do not know well. We are going to do a piece on investment management companies to try to figure out why they all sell at such low levels with the stock market at an all-time high. Makes no sense to me. We will come back. Ronnie in Massachusetts. Ronnie.
Hello, Mr. Cramer. How are you, sir?
I am good. How are you?
Good. First of all, I'd like to say today's a good day, but I'd also like to thank you for your generosity in teaching us all how to work this stock market.
Well, it's not generosity. It's just something I love to do, but thank you so much for your kind words. Let's go to work. What do you got?
So, two steel companies out of Brazil. One's Gerardo, it's GGB, and the other one is Vale.
Well, Vale is more a minerals company. GGB is a company that I don't really care for. If you want steel, you do Nucor. Vale is actually a very interesting company, but it's far more speculative than I like. And thank you for the kind words. Let's go to Mary in Idaho. Mary.
Good afternoon. Happy Friday the 13th, and thank God it's Friday.
Yeah, I agree with every one of those sentiments. How can I help?
I'm a loyal listener and frequent caller and someone who's working on getting funds together so I can become a member of your wonderful club.
Perfect.
I'd like to take just a moment, if I may, to commend and thank you for sharing your knowledge, expertise, and wisdom. You do a magnificent job educating the rest of us about the ins and outs of investing in a market that is frequently complicated and confusing, and you do it in an entertaining
very kind.
and positive fashion.
Thank you. And that's the way I want to do it. If I'm known for that, that's terrific. Rather than just what David Faber says, I'm known for working 100 hours, and I'm proud of that. I'm proud of what you just said. Thank you.
Oh, well, thank you. In my opinion, I believe you are a very, very valuable resource for any investor, whether it's new, somebody that's been in and out of investing for a long time or whatever.
You are way too kind. I hope I live up to you. I hope I live up to you, and the staff makes me look good every day. I'm pointing to the staff right now, I'm waving at them, and they're doing some sort of monkey shines. I don't know what it is. How can we help?
The stock I would like your advice on, I have owned for almost 3 years, Jim, and I've done extremely well with it until about a month or so ago when a law firm launched an inquiry against the company for quote, security-related infractions, unquote. Now it has become an investigation, and shareholders who feel they may have been affected or suffered losses are encouraged to call the law office. Ever since the investigation started, the stock has suffered quite a downturn. I don't know if this is something serious like J&J or something relatively minor. Regardless, it just seems to me that the stock has put its tail between its legs and run the other direction. Well, I would like to take your advice on what I should do with this, whether I should sell, hold, or buy, and it's Domino's. Symbol
Domino's.
DPC.
Okay. All right. First, I'm going to just ease your mind here. The lawsuit's meaningless. They just file these lawsuits every time the stock goes down, and I wish they would stop that. And if they keep doing it, I got to tell you, I think I'm thinking about major takeout on this nonsense because they hurt everybody, even the people I think they represent, frankly, because they charge so much, and there's not a lot of money that's going to come to anybody other than them. Domino's itself did screw up. They didn't know that they had a weak franchise that was missing its numbers from overseas. And that caused people to think that, wait a second, maybe they're not as in control of their destiny as we thought. And that's why the stock's going down. And that is an actual worry for me, too. And thank you for the kind words. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is there still room on the high-end sofa, or is RH done decorating your portfolio? Keep it here.
It's not my style to recommend a stock that's up 25% in a single day. But if I were ever going to stick my neck out like that, I'd do it for RH, the old Restoration Hardware. After its spectacular run today, this is an incredible retailer run by the iconoclastic Gary Friedman, the impresario of what's suddenly the hottest store in home furnishings. How'd he do it? Well, Gary's a high roller when it comes to betting on himself. For the last few quarters, as he built one-of-a-kind galleries, not stores, but galleries, some in castles, some in old factories, he's lamented the horrendous housing market, worse than 16 years. Although, in terms of the number of transactions, maybe a more important metric for his business, this might be the slowest housing market in modern history. Wall Street thought he was crazy putting up all these emporiums. How could he spend so much money building a luxury furnishing chain when mortgage rates were so high? And the stock was often punished with vicious sell-offs. But Gary never stopped believing, and he never stopped building, and he never stopped buying his own stock. Last time we saw what happens when things work out, you get an earnings explosion with a cadence that's downright breathtaking. Yep, the RH comeback kicked in this quarter and on the eve of a fresh rate cut cycle from the Fed. I think we'll see many more quarters like this one. Gary's one of a kind, like Sinatra. He does it his way. No social media, no tagging your stores to someone else or buying search keywords. Just gorgeous places of art, often with fabulous restaurants and breathtaking views. Real palaces done his way. Throughout the downturn, he bought stock, both for himself and for the company. He was early. He admits it. But you have to be early in this business, and the numbers are now extraordinary. Demand accelerated each month of the quarter, with July up 10%. May, August is up 12%. He has a stunning series of store openings coming up, perfectly timed. Now that the Fed's about to hit the accelerator on the housing industry. Now, you may not want to buy the stock of anything that's up 25% in one day, but everything related to housing is starting to take off. And just like RH did, you have to buy early to get ahead of the turn when mortgage rates plummet, thanks to the Fed. As Gary told us at the conference call, I'm quoting, despite expectations for industry conditions to remain challenging until interest rates ease and the housing market begins to rebound, we expect our demand trends to accelerate throughout 2024 and 2025. Yes, emphasis mine. On yesterday's CNBC investing call, which you can still access online if you join the club, I emphasized that you don't want to outthink this moment. The home builders are obvious winners. I interviewed Doug Yearley, the CEO of Toll Brothers, earlier this week, and while it's been putting up some excellent numbers throughout the whole tightening cycle, it's now ready to take advantage of what I'm betting will be an actual housing boom. People have been so reluctant to move because of high mortgage rates. Take that away, and this industry will come alive. Now, Toll stock is up over 45% for the year, and while I don't think you've missed it, if you want something with more room to play catch-up, check out Home Depot, which is only up 10% for the year. When a new housing cycle gets rolling, every aisle of the store comes alive, including the aisles that feature Stanley Black & Decker, which, while up a lot from its lows this summer, is still only up 3% for the year. We own both of them for my Chapel Trust, and if you want more rationale, sign up and watch that replay of yesterday's club call. I go over every one of them. And it's certainly not too late to buy Builders First Source, a distributor for home builders, or Lowe's, the finest do-it-yourself retailer in the land. They all work. But I don't want to throw cold water on RH because that stock's like a coiled spring. As Gary put it, quote, over 20 years, we began this journey with a vision of transforming a nearly bankrupt business that had a $20 million market cap and a box of Oxidol laundry detergent on the cover of its catalog into the leading luxury home brand in the world, end quote. It's now got a $6 billion market cap. Until yesterday's quarter, the skeptics abounded, and the short sellers, they just roamed free. Now they've been caught leaning the wrong way, and they need to buy back the stock in order to close out their positions. They're losing positions. Now, I don't know if RH will give you a better entry point than what we got at the close today, but I do know this. At this point in the business cycle, you bet against Gary Friedman at your own peril. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday from San Francisco.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.